Welcome, everybody, to Tokens of Wisdom. I'm your host, Dave Rothschild, and I'm super excited to have with me today Ron Falls Jr., who's a former GC at Fireblocks, and he's an angel investor, lawyer, and currently the CEO of LA Executive 9, which is a consulting group that provides an array of services to startups, political candidates, and executives. Before we dive into the episode, please listen to the disclaimer at the end of the show. Nothing we say here is legal advice, tax advice, or investment advice. And with that out of the way, Ron, thank you so much for joining me today.
Thank you for having me. It's a pleasure. Happy to be here and talking about this very timely subject.
Do you want to give the listeners a quick intro on yourself and background for LA Executive 9?
Yeah, my name is Ron Falls. I am the CEO of LA Executive 9. I have been a financial services executive. I've been in financial services my entire career. I started out as an analyst at Goldman Sachs, ended up becoming a lawyer, working in capital markets internationally, and then came back to the U.S. after doing some general counsel work. And my initial exposure to fund formation and fund work in Singapore was managing master feeder structures in the Cayman Islands for Singapore Advisor. Came back to the U.S. and ended up going to Legacy Asset Manager Post Advisory Group. They specialize in primarily high yield bonds, bank debt, and credit. And I got there at a time of transition. So was the general counsel and was managing our different strategies across duration, where we had different commingled fund structures that we were managing. Some were LPs that we converted to master feeder structure, Cayman structures, to take in investments. We managed assets for blue chip clients in the U.S. You name them, CalPERS, CalSTRS, OPERS. But we also managed money for blue chip clients offshore, sovereign wealth funds. So giving them access to the investment strategies required us to upgrade and convert some of the flagship vehicles that we had. So we worked with a fund administrator to do that. But in each of our strategies, we basically converted or upgraded to commingled fund structures to offer alongside separately managed accounts. We also did some sub-advisory work within those strategies for UCITS, QUAIF funds, 40 Act funds that we sub-advised on as well. So a lot of familiarity with sort of the different types of funds and compliance in different sort of jurisdictions. But then I left in 2021, and instead of sort of managing the business, I had become the COO. And that's where my exposure to digital assets sort of came from. And what we were managing, bank loans, we were looking for solutions, and the blockchain and digital assets sort of became that solution that we were starting to kind of emerge into. So as I've been consulting since that time, that kind of introduced me to my role at Fireblocks, where I was the general counsel for product and regulatory. And a lot of the conversations that we were having on Fit 21, ultimately what became the Genius Act, and last summer, 2025, is now what we're arguing about as the Clarity Act is now intersecting with the Genius Act and what that will mean for, certain participants, primarily exchanges in the most recent quarrel. So a very roundabout way to, I've been kind of eyeing these things and how TradFi and the digital asset, world kind of intersecting. And some familiar faces are starting to appear in the lobbying, sort of categories as we move closer to these, discussions. Actually, today is the Senate markup, conversation. So very timely.
Yeah, absolutely. And I mean, your experience is like the perfect mix to discuss this topic today. And so,
yeah,
let's dive into it. So I think as Ron alluded to, the topic for today is we're going to talk about the Clarity Act and specifically the controversy around the yield provisions with respect to stablecoins. As quick background, the Clarity Act, I have personally long been skeptical that we were going to get major market structure legislation anytime soon out of Congress. I've just seen congressional gridlock everywhere, and I thought this was such a big deal that it was going to be really difficult to get through. And then in the last month or so, it seemed like momentum was really picking up. I've been getting texts from friends who are only tangentially involved in crypto, and they're all excited. They're hearing about market structure legislation, the Clarity Act passing, and it seemed like momentum was on our side, and maybe we were moving toward a real bill passing. And then last week or the week before, I think there was a lot of news about Coinbase throwing up its arms and saying, we don't want to support the bill in its current form. So that's what we want to talk about today is why Coinbase said that. What is the problem that they and others in the industry have with what's being discussed in the Clarity Act now? And so to frame that, I think we have to know a little bit about what has come before, which was, as you mentioned, the Genius Act, which passed last summer. It was the first federal legislation specific to digital assets, and it created a regulatory framework for stablecoins. And one thing that it did is it prohibited stablecoin issuers, the people who are actually issuing stablecoins, from paying any interest or yield in any form to stablecoin holders. But as I emphasized there, the ban only applied to issuers. So Ron, can you talk us through how have third parties, specifically thinking of exchanges, been able to reward stablecoin holders even in this current paradigm?
Well, so there's what they call the loophole, and in this loophole, as you said, the prohibition is on issuers. A Circle or a Paxos who've issued a stable coin can't provide that yield directly to an end user, but an exchange, someone who may be holding the actual digital asset on behalf of that user, so a Coinbase, a Kraken, a Crypto.com, they have been sharing a portion of the yield that they're earning from their corporate holdings in a form of marketing agreements with these issuers. So there is a way for the rewards or these incentives, these loyalty incentives, to be shared with these users. But there's no actual contractual arrangement, contractual interest with these users. And this is where the push has kind of come back. And I think as going back to sort of how the Genius Act even got here, that was a piece of legislation that went through a lot of momentum up and down and iterations. And as you sort of saw, the complexity of both a House Finance and House Agriculture Committee getting that to a floor vote, getting that moved, and then waiting on the Senate to actually, take action on that. And now, the Senate moving to make this amendment or provision to address this, and the way that they've chosen to do this is with an amendment that is specifically targeted at this sort of a loophole, if you will, for these exchanges. And these exchanges have responded, specifically Coinbase. Brian Armstrong's response is specifically, you are now making an amendment in favor of lobbying industry, specifically the American Bankers Association, the ABA, and the Texas Bankers Association, to insert this amendment that would effectively deprive the exchanges of these loyalty rewards. And the sort of juxtaposition is there a way to consider the activity of what those deposits are doing? And is things like staking or other types of activity with the deposits analogous to bank deposits in the fiat sense, lending your money? I mean, that's the fractional reserve system. Your money, when you put it in the bank, it's not there the next day. That money has been lent out in the form of other products that the bank is trying to attempt to make a spread on. And the bank industry now is attempting to protect, that 4.5%, 5%, space for themselves. And what Brian, on behalf of the industry and, I guess on behalf of also the lobbying arm, the, Stand With Crypto sort of folks, is saying is that this is not tenable at the expense of the digital asset industry, and specifically the exchanges who've kind of gone through the sausage making process and kind of bringing us to this moment. So you have the 53 sort of banking association, trade associations on the other side of sort of this crypto conglomerate that has been doing both education and sort of development and sandboxing along the way.
Yeah. So it's super interesting. So I want to back up for a second and just kind of talk through, the difference between how banks operate and how stablecoin issuers and exchanges and that ecosystem operates. So put $100 into a bank checking account. Like you said, it's a fractional reserve system. That $100 isn't going to sit inside the bank. The bank is going to turn around and lend that $100 out, or go invest that $100 or use it to make money for the bank. This is how the bank makes money. usually a bank is not paying me much interest on my deposits. I'm getting a very tiny, tiny fraction of interest, maybe. And then whatever money the bank makes by using my money, they're pocketing as their profit. This is their business, right? And with stable coins, I think my understanding, and please correct me if I'm wrong, is that it works a little differently. I put $100, I buy $100 worth of stable coins. That stablecoin issuer, to be compliant with the Genius Act, has to buy $100 worth of U.S. Treasuries or just keep the $100, some safe reserve asset. And if they're buying treasuries, those treasuries are generating some sort of yield, right? They're paying interest to the stablecoin issuer. Now, the Genius Act prohibited stablecoin issuers from passing that yield along to me as the holder of that coin. But I guess the way it works, the loophole you described, is that Circle enters into an agreement with Coinbase and says, Coinbase, I'm going to pay you some percentage of this profit I get for you, marketing my stablecoin and helping your customers hold my stablecoin. And then Coinbase turns around and says to users, hey, if you buy this stablecoin through us and you hold it here, we will pay you some modest reward of some form. Is
Correct.
that accurate?
Yes, I think that's spot
Okay.
on. And I think what now the debate comes down to is, what does it mean for that money to sit in an account? And if it's analogous in the fiat sense, when that money goes in there, it's understood that that bank is lending that money out and making loans with that money. But the bank is also under the benefit of the backstop of the FDIC. And the FDIC is going to ensure a certain amount of deposits for U.S. account holders in these situations. Analogously, the crypto industry doesn't have the same sort of backing and full faith and credit of the FDIC, even to an amount, whether that be, a couple $100,000, what have you. But what crypto is offering, because of the technology, is the ability to do something like staking or participate in some other reward-like or yield-like mechanism that returns that back to the user for allowing the crypto holder to benefit from the fact that they own this asset and it's participating in something that's generating yield. The same way that the bank would use that cash to go try to use that yield. The question is then, what should be the benefit to the end user? Should they get to benefit in more of that spread? You alluded to the difference about how crypto and the stable coins are being legislated to be protected by treasuries and by cash reserves. And so that protection and that cash liquidity is meaningful. That means that those assets can immediately be returned for something tangible. Cash is immediately transferable. That is only insurable in the banking situation up to what the FDIC will provide you. So the losses are potentially more. The banks have argued that there is potentially the attractiveness of these crypto exchanges taking away some of these fixed deposits because of the amounts of yield, and they're making that as part of the opposition to what would happen to the banking system, the fiat banking system, because of a more attractive product for these deposits in the equivalent in these digital asset exchanges. And so there's a tension now between where we settle down and what that yield that should be available to the end user is going to be. It could potentially be a compromise in this banking amendment discussion where there is more made available to end consumers, and that maybe is a compromise. But right now, it seems that Brian has drawn a pretty clear line in the sand about this being untenable to the exchanges, because it would effectively wipe out a significant amount of both their business and would benefit specifically the banks, the fiat banking system, the thing that the crypto has been sort of created to challenge.
Yeah. So I guess to take it back to first principles a little bit, it's the Clarity Act, the banking associations, the banks, are trying to introduce amendments to the Clarity Act that will prevent exchanges like Coinbase, for example, from paying rewards to stablecoin holders. And their thinking is doing so is necessary. I mean, I guess this is what their argument would be. Doing so is necessary to protect the business model for banks. And the reason that they need, I guess, extending the argument, the reason they need to protect that business model is because banks loan money to individuals and small businesses, and, the economy sort of lending ability of banks would be disrupted if, all of a sudden stable coins are paying higher yields. So customers, instead of putting their $100 in their checking account for the bank to do what it does with it, are going to put that $100 into stable coins and pocket that difference. Is that the crux of their argument?
Correct. And I think that is exactly what they see kind of happening. Some of these exchanges offering better yield. I mean, the marketing is basically the proof of what they want to stop. These abilities to sort of provide this yield that they have directly to clients for an activity. So come hold the money in the fixed deposit account and maybe stake it. Leave it for a period of time. And if you're able to hold it, for whatever the staking, is, that is going to return this amount of yield. And that's hard for the banks to continue to have that margin if people realize how fungible that is, how easy it is to transfer that fiat currency into a stable coin, and to know that there is trust in that stable coin because of the backing of the stable coin. I think that is a lot of consternation for the banking industry.
Yeah. Do you think there is merit to their argument? I mean, do you think that if users, if customers, if you or I could get this yield from buying stable coins, are we going to take en masse our money and move it out of banks and into stable coins?
Well, I think that you have to look at what the evidence is, and is there going to actually be the adoption of stable coins to the detriment of fiat currency? And I think that what you see is an early adoption, an early sort of curiosity, still in a sort of sandboxing stage of building solutions for the technology. I do think that stablecoin adoption is going to continue to apply pressure to banks to return some of that yield to the end users. I think the fact that this issue has been exposed as sort of a political issue now. I mean, the conversation at Davos from the Trump administration was that this was a priority. Getting this legislation passed was a priority, and the fact that a couple of years ago this was not the same sort of conversation around crypto and digital asset industry in terms of global politics, geopolitics. So the significance of it is that something's going to happen. There's going to be legislation that's going to happen because it is political expediency. It's because the rules that people have been asking for are also contained in this market structure bill. We will finally have determination of what the SEC is responsible for, what the CFTC is responsible for. I think that will ultimately apply a lot of pressure. There is a break in the crypto industry. There are people who are not aligned with Brian Armstrong and the exchanges on this. So that is, something to note, what that will look like, what ultimately the lobbying pressure of the banking industry kind of comes down on. We're down to this, very specific section in this yield discussion of this bill. And you see where you didn't have compromise or even communication. If you look at what Senator Warren's position was in the last Senate cycle, there was no sort of meeting with the crypto industry, no meeting with Kristen Smith and, the Blockchain Association on the comment process. You had a lot of activity from, Chair McHenry on the House Finance Committee and his staff working on the legislation and the compromises on everything from custody to sort of market structure. And that's where you got sort of the stablecoin bill and sort of the market structure bill originating in that work. Since then, you've seen now Tim Scott, picking up the kind of conversation and moving it forward, and having the input from new Senator Brooks from Maryland on the amendment, trying to define what is activity, what will we see as a compromise for things that are justifiable for earning yield for the end consumers. Exchanges will have an advantage on still being able to provide those products. They've been working on these problems, stablecoin yield, how to provide yield to the different coins, what will be accepted as coins that provide yield on these exchanges. That's been happening in the sort of the regulatory and legislative process in both New York and California over the past couple of years. And so now here we are, we're finally getting the regulatory clarity at a federal level that we've been asking for. And I think the fact that everyone's not going to be happy is probably indication that we're coming down to landing the plane somewhere.
That's a really good way to think about it. And I think you're absolutely right to point out that the Clarity Act does so many things, and so many of them are unabashedly positive for the industry, right? I think there's a lot of strong developer protections in the Clarity Act. There is this attempt to set clear regulatory thresholds when something is governed by the SEC, when it's governed by the CFTC. And so, this bill is attempting to answer a lot of the super big questions. And, maybe a natural consequence of a bill this large is that when it gets down to actually making the sausage, there's going to be very specific points of disagreement among various industry participants. And it's so interesting to see, like you pointed out, that, there's kind of a split in the industry. There's Brian Armstrong at Coinbase and exchanges who are really laser focused on this stablecoin yield issue. Whereas, you hear other people talk about it who are passionate crypto people, and they say, look, on balance, this bill is doing a lot of good for us. Let's get it over the finish line, and we'll, make tweaks from there as the industry progresses. And so it's super interesting to see it all play out. But coming back to the stablecoin yield discussion, I guess, it sounds like, in your perspective, maybe there's some, at least theoretical, merit to the idea that if there is some other safe place to park your dollars that and there's a way to earn more yield on those dollars than you can at a bank, that maybe over time fewer people are depositing money in banks and more people are depositing, buying stablecoins and doing with them what they might. So I guess maybe there's some argument to the bank's position that maybe this has some long-term impact on deposits, I guess. But even if that is the case, I'm wondering, is it the government's job to kind of pick winners and losers? Because I'm hearing you say there's a middle ground here where you could say, it's not just holding the stable coin that generates the yield. It's, you have to do something with that stable coin. You have to stake it. And that is economic activity, the same as whatever the bank is doing with your money. And what business is it of the federal government to say, I'm going to tell me where I can direct my dollars toward what economic activity?
I'm definitively a securities lawyer because I believe, sort of the role of the SEC, and it is not to pick winners and losers. It is not to call, who is going to succeed and who's going to fail. It is to set the standard by which everyone must operate. And, it's kind of one of the other things too. Even after this legislation is passed, the SEC and the CFTC also have a rulemaking process that follows this, that is going to kind of set the rest of the lay of the land for what comes next. Once they get this long requested guidance from the federal government on how do we do this, to the point on the yield, I think it's pretty protectionist. And I think it's by how you've seen this kind of come out in uniformity, and the banking association's very clear and very specific request at the last minute to safeguard this yield. What I hope happens is that this is going to be additional pressure on the banks to provide that yield and to provide better products to their end users and end consumers. And what I hope is happening is there's now a competition. What I'm sure a lot of the exchanges would like is, if there is going to be oversight, and in addition to sort of the federal regulation that they're getting in this Clarity Act, is there an opportunity for the FDIC insurance to also extend to some of these exchanges and institutions to provide additional trust for some of the digital assets that they're offering? I don't know where the line gets drawn in that, but I don't think that the federal government is in the interest of deciding when technology is advantageous to progress it and when it's not, to sustain the old model. I think the banking industry and sort of the financial services industry for a long time has needed innovation, and sort of technology, I think, has been sort of an Achilles heel of the financial services industry for some time. And now you're seeing a rapid acceleration of that.
Yeah, absolutely. And I think, there's always tension when there's new technology, because entrenched, legacy players have to either compete with this new technology or they get left behind. And so I think you're absolutely right that if there is something that can compete with banks for your dollars, I think in the long term, that's not a systemic problem. I think that probably works to the benefit of the end user, of the consumer, because they have more choices. The companies who are competing, the banks and the issuers of stablecoins who are competing to get those dollars, have to offer products that are more enticing to those customers.
And now that competition is also global. I mean, the other thing that that is happening in Europe with Mika is these other opportunities to earn yield on these other euro currencies or in Chinese currencies is now something that is going to impact how the digital dollar is going to evolve. And so, as people are having these conversations and these technologies are evolving, I don't think that the US is going to have the benefit of waiting to see how the tide settles elsewhere while development and innovation are clearly moving forward. And so is the regulatory apparatus in other places.
Hmm. Yeah. So what happens if we get left behind? What happens if this bill passes the Senate with the banker's amendment, so to speak, and there's no yield paid on stablecoins for anything? Aren't I, as a U.S. consumer, just going to look toward Asia or toward Europe and buy stablecoins there that are denominated in different currencies?
Well, I think then that you get into to how far then does the protectionist, bit go? Also outlined in sort of the Genius Act were sort of the coins of favor. So you get clear treatment on things like Bitcoin, Ethereum, XRP, and a few others. But I think when you start to get into trying to safeguard the innovation and keeping people away from those assets, it doesn't have the impact or the effect that you want. I think you do want the CBDC conversation to kind of work in your favor of strengthening the US dollar. I do think you want to have collaboration and development. And I think that there is a middle ground between protecting the interests of the banks who are also developing and sandboxing these technologies themselves and also allowing innovation to happen within the digital asset space by these exchanges and even some of the issuers who are interested in seeing a middle ground reached. I'm sure that if you see where Circle and Paxos and some of the other issuers are, they also want this regulatory clarity to a clear place that benefits them to develop and innovate here. They want to build in the US. They want to have access to the US consumer base. This is still
Hmm.
where a large percentage of digital asset users are based, and they'd like to benefit from that.
Yeah. So much of this discussion has echoes to things that I've talked about a lot on this show and that my listeners are well aware of that has been sort of plaguing the digital asset industry in the US for years, right? Like in the Gary Gensler SEC era, there was such an attempt to blanket ban this activity altogether that people had to look at solutions outside the US, and it drove a lot of economic activity outside of the country. And so I think people are optimistic and excited that we're moving forward with what everybody hopes is going to be sensible legislation that keeps that economic activity here. But even as we move forward, there's still echoes of that same argument taking place in new forums like this banking amendment to the Clarity Act.
Definitely. And I would tell the politically inclined is a takeaway to tell your senator is that you do want access to a digital asset technology and the innovation, and you do want the yield that the banks may be hoarding for themselves. We've seen signals from the administration of where they've given very specific directives on how they feel about charges and fees. I don't know what that would look like in the form of the yield conversation, but when the president says this is an imperative and this is a legislative imperative, even some of the things in the bill are going to be constraining to him and his family as they're continuing to build within the digital asset space. A lot of their recent wealth has kind of been accumulated in the ledger
Mhm.
sense. So I think because it is an imperative, something's going to happen. And I think that if people are paying attention to this, and I think Stan with Crypto's done a great job is sort of making people aware and sort of educating on the issues, then hopefully people are asking their local senators for protection from the banking industry, from stealing the yield available to them through this technology. Stablecoins should be an opportunity for that yield to benefit the end users. So liberate the yield.
Liberate the yield. I love that. That's probably a perfect spot to end here. If you take anything away from this episode, listeners, call your senators and say liberate the yield, please. Well, Ron, thank you so much for joining me and sharing your wisdom. I feel much smarter now having spoken to you, and I really appreciate it.
It was a pleasure. Thank you for having me. And hopefully everybody got a little something from this.
Absolutely. Take care. Okay, with that scintillating conversation out of the way, we can get to the part you've all been waiting for. The legal disclaimer. On this show, my guests and I discuss laws, regulations, and aspects of fund management from a 10,000-foot view. And nothing I say here, nothing my guests say here is legal, investment, or tax advice. Everything we say is our own personal opinion. Nobody is speaking on behalf of their employers on this show, and it is entirely for educational purposes only. If you're thinking about starting a fund or you're curious about what's involved, this show is a good resource as you explore your options. But if you're going to pull the trigger and actually launch a fund, please engage professional service providers to assist you in the process.